This is a review of the first exam from the fall of 2013. It starts out with multiple choice questions, 15 of them that are 2 points each. So let's get started and take a look at this. Let's see. Number 1 says neutrality means that information A provides benefits which are at least equal to the cost of its preparation. Now that's the cost-benefit principle. Can be compared with similar information about an enterprise at other points in time. It has to do with comparability. Or consistency. Would have no impact on a decision maker, and that one runs directly counter to what we have in mind. And cannot favor one set of interested parties over another, and that's probably what we're looking for there. Is can D the correct answer there? Number 2 says, how does failure to record accrued revenue distort the financial reports? Well, if we don't accrue revenue, what we would do is debit accounts receivable to accrue some revenue, let's say $100, and credit revenue. This would be an accrual of revenue. And if we don't do that, then we would be understating revenue because revenue would be higher here. We would be understating net income because revenue would be higher, and we would be understating current assets accounts receivable. So I kind of like, right off the bat anyway, I like A as the correct answer here for number 2. Number 3 says, of the following adjusting entries, which one would cause an increase in assets at the end of the period? The entry to record the earned portion of rent received in advance, well, that would be a debit to a liability, unearned rent, and a credit to revenue. And what we're looking for here is something where there's an increase in assets. Debit to a liability and a credit to revenue doesn't affect that. An entry to accrue unrecorded interest expense, normally that would be a debit to interest expense and a credit to interest payable, and that does not involve assets. And the entry to accrue unrecorded interest revenue, that sounds pretty good. Interest revenue. Maybe we now have somebody that owes us $50, and we have, I'm sorry, that's interest receivable, that's a common mistake, and interest revenue would be credited for $50. A debit to the interest receivable and a credit to interest revenue, and that would cause an increase to our current assets, interest receivable, at the end of the accounting period. So I think the answer that we're looking for there is going to be C. D says the entry to record expiration of prepaid insurance. Well, that would be a credit to prepaid insurance and a debit to interest expense, and that would decrease assets, not the direction we want to go. In number 4, it says, why is it necessary to make adjusting entries? Because accountants have made errors in the past? I don't think so. We make adjusting entries all of the time, and they're part of the normal process. B says certain facts about the affairs of the business are not included in the ledger as built up from external transactions. That sounds pretty good. C says the accountant wants to show the largest possible net income. Well, that's not true. I mean, we may have to record expenses, not revenues. That would impose a bias, and that's not what we want to do. And D says the accountant wants to show the net cash flow. Well, no, that's not true. What we're doing this is for the accrual basis, not the cash basis. The accrual basis is what records revenues when earned and expenses when used up. So I think the best answer here is going to be B. Certain facts about the affairs of the business have not been recorded, so let's get it done. All right, moving on. Next one, number 5, it says, Consistency is best demonstrated when expenses are reported as charges against the period in which incurred. B, the effect of changes in accounting methods is properly disclosed. So here we might say something like, we went from LIFO to FIFO during the year. Last year we used LIFO, this year we use FIFO. But had we used FIFO last year, this is what it would have been done, and this is how the results from last year, and this is how they are this year, both on FIFO. Extraordinary gains and losses are not reported on the income statement. That really doesn't have much to do with consistency. What we're talking about is something across time. And D says accounting procedures are adopted which give a consistent rate of return. Now there's a bias because maybe the business doesn't have a consistent rate of return. I think the best answer here is going to be B, the effect of changes in accounting methods is properly disclosed. Moving on. Maso Company recorded journal entries for the issuance of common stock for $160,000, the payment of $52,000 on accounts payable, and the payment of salary expense of $84,000. What effect do these entries have on owner's equity? So if we create an owner's equity T account on the right-hand side of the accounting equation, when we issue common stock, we debit cash and credit owner's equity, specifically contributed capital, but it's all part of owner's equity. When we pay accounts payable, we credit cash and debit a liability. There is no effect on owner's equity. And the payment of salaries expense, well, that's going to be a credit to cash and a debit to salaries expense, which has the effect of decreasing owner's equity. What effect do these entries have on owner's equity? Well, 160 minus 80 is 80, minus 4 is 76,000. It's a net increase because it's on the right-hand side of the accounting equation, so I think what we're looking here is for C. In number 7, it says Garcia Corporation received cash of $36,000 on August 1, 2014 for 1 year's rent in advance and recorded the transaction with a credit to rent revenue. So we have a debit to cash, and that was for $36,000, and a credit to rent revenue. And that was for $36,000. And at December 31, 2014, the adjusting entry, so it was for a year rent in advance. So let's count them on our fingers. August, September, October, November, and December, 5 months have actually been earned. If you take 36,000 divided by 12 is equal to 3,000 per month, times 5, or 15,000 is what has actually been earned. So we want this to be 15,000, and we're going to debit rent revenue for 21,000 and credit a liability, unearned rent. And that liability is going to be credited for 21,000. And that's these two, here and here. See, debit to unearned rent revenue, debit to rent revenue, and a credit to unearned rent revenue. That's this one here, B. In number 8, it says, if plant assets of a manufacturing company are sold at a gain of $1.5 million less related taxes of $450, the gain is not considered unusual or infrequent. The income statement for the period would disclose these effects as, well, we would have a gain of $1.5 million and an increase in income tax expense of $450,000. This is all going to go as part of income from continuing operations, it would not, this is close, but it's not the best answer. This is the best answer. Operating income net of tax. Normally, we don't consider sale. Some companies, anyway, would not consider that as part of operations, something non-operating, other revenue and expense. But so it would not necessarily be included in operating income, and most companies would say exclude that. So it would be in a gain of 1.5 million, which would be in other revenue and expense, and an increase in income tax expense of 450,000. Both of those are absolutely true and the best answer. It has nothing to do with a prior period adjustment, which means that there's been an error, or an extraordinary item, which means that it was unusual and infrequent. So the best answer there is going to be A. In number 9, Manning Company has the following items: write-down of inventory, 360,000, loss on disposal of the sports division, 555, loss due to strike, 359. What amount should Manning report as extraordinary losses? Well, a write-down of inventory is not unusual. A loss on disposal of a division is not unusual, and a loss due to a strike is not unusual. I think the best answer here is and infrequent. 0 is the best answer. Lantos Company had a 40% tax rate. Given the following pre-tax amount, what would be the income tax expense reported on the face of the income statement? So what we're looking for here is everything except extraordinary losses and discontinued operations. Those two items are shown have income tax separate. So we're going to include this, cost of sales and cost of goods sold, salaries and wages, depreciation and expense. We're going to include dividend revenue. We're going to include utilities expense. We are not going to include extraordinary loss because that's shown separate, and we will include interest expense. So if I take the 500,000 of sales revenue minus 300 of cost of goods sold, that's 200,000 of gross margin. Minus 40 is 160, minus 55 is 105, plus 45 is 150, minus 5 is 145, and minus 10 is 135. 135,000 times 0.4, 0, 0, 0, 0, 14, 6, I'm sorry, 54,000, which is going to be A. 54,000. What is the amount of income tax expense? Let's do that math again. 0.4 times 3 is 320, 14 plus 4, 54,000. Okay, so A is the correct answer there. Number 11 says, where must earnings per share be disclosed in the financial statements to satisfy generally accepted accounting principles? A says on the face of the statement of retained earnings, or on statement of stockholders' equity, in the footnotes, on the face of the income statement, on the face of the balance sheet. The answer here is clearly on the face of the income statement. Number 12 says Benedict Corporation reports the following information: net income, dividends on common, dividends on preferred, weighted average common shares outstanding. They should report earnings per share of, well, when we're talking about earnings per share, we are talking about earnings per common share. So we're going to take the net income, which is 750,000, minus preferred dividends, because they get paid first, and that's going to be 90,000. 90,000 means that there is going to be 660,000 income available to common divided by 150,000 common shares is going to be 66 divided by 15, which is going to be 460, 6, $64.40 per common share. The answer there is going to be C. Next up, we're going to take a look here at treasury stock should be reported as a current asset, an investment, another asset. None of those are true because you can't own yourself. What you're doing is reducing the amount of stockholders' equity with a debit to stockholders' equity and not a debit to any asset. Number 14 says Olmsted Company had the following items: common stock, treasury stock, deferred income taxes, and retained earnings. What total amount should they report as stockholders' equity? So stockholders' equity is going to have, we'll just create one overall stockholders' equity account. So there's going to be $750,000 for common stock. There's going to be a reduction in stockholders' equity for $105,000. This is the treasury stock. Deferred income taxes are either an asset or liability, and retained earnings, that goes into stockholders' equity, $454,000. So we have 4, 10, 12 minus 105 from the left-hand side is 9. 9 minus 0 is 9. 11 minus 1 is 10. And that's going to give us $1,099,000. And then we move to number 15. If common stock was issued to acquire an $8,000 machine, how would the transaction appear on the statement of cash flows? Well, this specifically relates to the statement of cash flows, and here this is going to be a proceeds. Basically, it's going to be a non-cash investing and financing activity, and that's because there's no cash involved, but we're going to disclose this as a footnote. There you have the first 15 questions of the fall 2013